Hey everyone, welcome back to the channel, where we cut through the noise and get to the real story behind the markets. If you're into precious metals, trading, or just protecting your wealth in these crazy times, buckle up because today's video is a must-watch. Let's break down what really happened today. February 19th, 2026, 5 p.m. Eastern Time. Silver closed at $78.55 per ounce. And structurally, this was not a routine pullback. We're seeing something far more alarming unfold in the COMEX silver vaults, where inventories have plummeted to critical lows, sparking fears of an outright physical shortage that could send prices skyrocketing. Why are traders paying attention right now? Well, over the past week alone, registered silver stocks, the stuff actually available for delivery against futures contracts, have dipped below 100 million ounces for the first time in years. That's a massive red flag in a market where industrial demand from solar panels, electronics, and EVs is exploding, while mining supply struggles to keep up. On the surface, it looks like just another dip in inventories, maybe some routine reallocation or paperwork shuffle. Headlines are screaming silver shortage imminent, with images of empty vaults and panicked buyers scrambling for physical bars. But what most people are missing is the deeper structural shift, the disconnect between paper futures and physical metal. Banks and big institutions have been shorting silver futures heavily, betting on price suppression, but now deliveries are surging as buyers demand the real stuff. This isn't hype, it's a potential squeeze that could mirror what we saw in nickel, or even GameStop, but with real-world commodities. By the end of this video, you'll understand exactly why COMEX vaults are draining, who's behind it, what it means for prices, and how to position yourself without falling for the panic. We'll fact-check the claims, dive into the mechanics, explore counter-arguments, map out what's next, and wrap with actionable insights. Stick around, this could change how you view silver forever. Let's start with the shock. Imagine logging into your trading app and seeing silver spike 5% in a day because a major depository reports another multi-million ounce withdrawal. That's not fiction, it's happening now. Registered stocks hit 98 million ounces yesterday, down from over 150 million just months ago. Eligible stocks, the metal in vaults but not yet registered for delivery, are holding steady around 200 million. But the key is that shift from eligible to registered is slowing, hinting at owners hoarding rather than selling. Traders are buzzing on forums like Reddit's Silverbugs and Twitter, with posts like "the vaults are draining" going viral. But is this the start of a silver moonshot to $100 or more, or just market manipulation in reverse? On the obvious side, silver's role in green energy is undeniable. Solar demand alone could eat up 20% more supply this year, per industry reports. Add in geopolitical tensions, think supply chain disruptions from China, the top producer, and you've got a perfect storm. Most folks see the price chart dipping slightly today and think, oh, no big deal. But zoom out. Silver's up 138% year over year, yet inventories are crashing. That's the mismatch. What you're missing if you stop at headlines: the futures market is leveraged 101 or more, meaning for every ounce of physical silver, there are paper claims that could overwhelm supply if everyone calls for delivery. We've seen delivery notices spike to record levels this month, with over 5 million ounces demanded in a single day last week. This isn't retail investors. It's big players like hedge funds and manufacturers locking in metal before it's gone. The promise here? You'll walk away knowing how to spot the signs of a true shortage versus temporary noise, armed with data to make smarter decisions, whether you're stacking physical silver or trading options. Let's dive in. Picking up right from that promise. Before we interpret anything, we need to ground this in cold hard facts. What actually happened? Verified numbers only, folks. No speculation yet. According to the latest CME Group data from February 18, 2026, COMEX silver warehouse stocks show total eligible inventory at approximately 198 million ounces, with registered stocks, the portion available for immediate delivery, plunging to 98.1 million ounces after a single-day drawdown of over 3 million ounces. That's from official reports, not rumors. For context, registered levels hovered around 120–150 million ounces throughout 2025, so this is a 35% drop in under 6 months. Timeline of events leading here. It started in late 2025 when industrial demand ramped up. Solar photovoltaic installations hit record highs globally, consuming 150 million ounces annually, up 25% from 2024. Per the Silver Institute's data. Then, in January 2026, Shanghai silver prices began trading at a $10 premium over COMEX spot, unheard of, signaling Asian buyers sucking up physical metal. By early February, delivery notices on COMEX futures exploded. February contracts saw 1,200 notices for 6 million ounces, far above the average 300–400. Last week, a major adjustment hit. Brinks and JP Morgan depositories reported outflows, with JPM alone seeing 2.5 million ounces moved out of registered category on February 11th. What's confirmed versus assumption? Confirmed. Inventories are at multi-year lows. CME's daily stocks report verifies the numbers. Total silver in vaults is 296 million ounces combined, but only a third is registered. Deliveries are up 50% year over year. Price action backs it. Silver touched $89 in early February, before pulling back to $78.55 amid broader market volatility. Assumptions? That vaults are empty. Not true. Eligible stocks are stable, but the registration process is voluntary, so owners might be withholding to wait for higher prices. Headlines claim critical shortage, but globally, above-ground stocks are estimated at 1-2 billion ounces. It's the COMEX-specific crunch that's the issue. Separate headlines from measurable data. Screaming titles like Silver Vaults Empty come from sites like Kitco or Zero Hedge, but data shows vaults aren't empty. They're just not registering metal for futures delivery. Measurable open interest in silver futures is 150,000 contracts, 750 million ounces equivalent, but physical backing is only 296 million. That's a 2.51 paper-to-physical ratio, down from 3:1 last year, per CFTC Commitments of Traders report. Normal versus unusual. Normally, registered stocks fluctuate 5 to 10% monthly. This 35% drop is unusual, echoing 2021's squeeze when stocks fell to 100 million and prices rallied 50%. To establish credibility, let's clarify. I'm pulling from official sources: CME, CFTC, Silver Institute. No cherry picking. For instance, while Reddit threads hype manipulation by banks, data shows managed money long positions are down to 11,657 from 57,000 a year ago, meaning speculators are cautious, not driving this. Unusual part: the backwardation in futures, near-term contracts pricier than later ones, signals immediate scarcity. Normally it's contango. This sets the stage for why this matters. Now, with facts in hand, we can interpret without bias. Picking up straight from those verified inventory numbers and the unusual registration slowdown, let's now get into the actual mechanism driving this COMEX silver drain, because understanding the engine behind the move is what separates informed observers from the crowd chasing headlines. At its core, this is a classic case of physical demand overwhelming the paper market's ability to suppress prices through short positions. The key structural driver is the massive surge in standing for delivery on COMEX futures contracts. When a long holder takes delivery instead of rolling over, they issue a notice, and the short must provide physical metal from registered stocks. In February 2026 alone, delivery notices have already exceeded 15,000 contracts, equivalent to 75 million ounces, far surpassing the typical monthly average of 3,000–5,000. That's not retail stacking coins, that's industrial users, refiners, and large allocators. Think jewelers, solar manufacturers, and even sovereign entities, deciding they want the metal now, rather than trusting paper promises. Why now? The incentives have flipped. For years, banks like JP Morgan maintained huge short positions in silver futures, peaking at over 100,000 contracts, net short in managed money categories, back in 2023–2024, while simultaneously holding massive physical positions in COMEX vaults to hedge and profit from the carry trade in contango. But as Asian premiums exploded, Shanghai spot trading $8–12 above COMEX in January, and as global industrial offtake accelerated, those shorts became dangerously exposed. If too many longs stand for delivery, the shorts must buy back futures or source metal elsewhere, at higher cost. Market positioning tells the story. CFTC's latest Commitments of Traders report, released February 17, 2026, shows commercials, the hedgers, largely banks, still net short roughly 80,000 contracts, but their short exposure has shrunk by 25% since October 2025, as they cover to avoid forced liquidation. Meanwhile, managed money longs are light at only 12,000 contracts, meaning this isn't a speculative frenzy driving prices, it's genuine physical demand pulling metal out. Liquidity in the futures pit is thinning. Bid-ask spreads on front-month contracts widened to 15–20 cents during heavy delivery periods last week, compared to the usual 2–5 cents. Flows confirm it. Major COMEX depositories: Brinks, Delaware, HSBC, Manfra, Scotia, and especially JP Morgan, saw net outflows of registered silver totaling 22 million ounces in the past 30 days. JP Morgan's vault alone dropped from 85 million to 71 million registered ounces since December. These aren't random moves. When a client, manufacturer, or ETF requests withdrawal or reclassification to eligible only, it reduces available deliverable supply. The consequence chain is clear. Heavy delivery notices, RU shorts, scramble for metal, registered stocks plummet. Backwardation strengthens, March contract now 45 cents over May. Spot price finds bids higher to attract new supply. RU more longs stand for delivery, creating a feedback loop. Evidence backing this explanation is robust. First, the Silver Institute's 2025 supply-demand balance projected a 215 million ounce deficit for 2026, third consecutive year of structural shortfall. Second, ETF holdings in SLV and physical trusts rose modestly, but Asian private demand via Shanghai and Hong Kong is estimated at 300+ million ounces annually, much of it bypassing COMEX entirely. Third, mining output growth is anemic. Primary silver production rose only 2% in 2025, while byproduct silver from copper-zinc mines faces headwinds from lower base metal prices. This matters more than the headline vaults emptying, because it reveals a regime change. The old suppression playbook, flood paper shorts to cap rallies, is cracking under real-world consumption. COMEX isn't the global silver market. London OTC and Shanghai dominate volume, but it sets the benchmark price. When its physical backing erodes, confidence in that benchmark erodes too, potentially forcing a violent re-rating higher as participants seek alternatives like physical bars, coins, or even private vaults. Continuing directly from that structural squeeze dynamic, it's only fair and intellectually honest to examine the counter-arguments that seasoned professionals are weighing right now. Not everyone is convinced this is the prelude to a historic silver breakout, and there are legitimate data points suggesting caution, or even that the move could prove temporary. The primary alternative explanation is that this is a self-correcting inventory shuffle, rather than a terminal shortage. Many analysts, including those at CPM Group and even some at UBS, argue the rapid drop in registered stocks reflects strategic repositioning by vault owners, not panic buying. Eligible inventories remain robust at approximately 198 million ounces, meaning plenty of metal sits in COMEX warehouses. It's simply not being offered up for futures delivery because owners anticipate higher prices later in 2026 or 2027. Once backwardation incentivizes enough arbitrage, buy spot, sell futures, store metal, registration could rebound quickly, potentially adding 20-40 million ounces back in a matter of weeks, as seen in past episodes 2011, 2021. Data that contradicts the critical shortage imminent view includes global refined silver supply still exceeds 1 billion ounces annually when including recycling. Silver Institute estimates 2026 total supply at 1.05 billion ounces versus demand 1.22 billion ounces, a deficit, but not apocalyptic. COMEX inventories, even at current lows, are still above the 80 million ounce floor that triggered the 2021 rally, without causing default. Moreover, open interest has actually declined 15% since January peaks, suggesting reduced speculative leverage rather than building pressure for a squeeze. Cautious voices are watching different signals. The gold-to-silver ratio, currently at 78:1, down from 91 last year but still historically elevated, implies silver remains undervalued, but not yet in euphoric territory. Industrial demand forecasts could soften if global manufacturing slows. China's PMI dipped below 50 in January 2026, raising recession fears that could curb solar and electronics offtake. Also, JP Morgan's physical holdings remain enormous. If they chose to re-register metal, perhaps to facilitate client hedging, the empty vaults narrative collapses overnight. Conditions that would invalidate the primary squeeze view are straightforward. 1. A sharp increase in registered stocks over the next 2 reporting cycles. Next CME update, February 25th. 2. Futures returning to contango with spreads widening to 30+ cents. 3. Delivery notices dropping below 3,000 contracts per month. Or 4. Silver price failing to hold above $75 on a weekly close despite the backwardation. If any of these occur while industrial data weakens, the current drain could prove to be a short-term aberration driven by seasonal factors, Chinese New Year hoarding, rather than structural breakage. In balance, the bear case doesn't deny the deficit. It questions the speed and severity of the COMEX-specific manifestation. Smart money isn't yelling moon yet. They're monitoring for confirmation or falsification. That brings us to exactly what those key triggers look like moving forward. Building on those invalidation conditions from the counter-narrative, let's map out a clear roadmap for what's next in this COMEX silver saga. A decision tree of sorts to help you navigate without knee-jerk reactions. We're not making predictions here. Instead, we'll outline key indicators, levels and scenarios that could shape the direction, separating short-term noise from structural trends. First, the pivotal indicators to watch. Start with the weekly CME Warehouse Stocks Report, dropping every Friday, next one February 24, 2026. If registered silver dips below 90 million ounces, that's a bearish signal for shorts, potentially accelerating the squeeze above 110 million would lean toward the counter view of replenishment. Pair this with CFTC commitments of traders out Tuesdays. Monitor commercial net shorts. If they fall below 70,000 contracts, it suggests banks are covering aggressively, fueling upside. Delivery notices via CME daily bulletins. Sustained above 4,000 contracts monthly points to ongoing physical pull, under 2,000 signals easing demand. Critical levels in price action. Silver's immediate support sits at $75.50, the 50-day moving average where buyers stepped in during the recent pullback. A break below could test $70, aligning with the 200-day MA, but holding above opens the door to retest $85 highs from early February. Resistance looms at $82, Fibonacci retracement from 2025 lows, and psychologically at $100, a level not seen since 1980 adjusted for inflation. In futures, watch the March-May spread. If backwardation exceeds 50 cents, scarcity intensifies, flipping to contango over 20 cents eases tension. Upcoming data releases and triggers. February 28th brings U.S. GDP revisions. Stronger growth could boost industrial silver demand via manufacturing PMI. Watch for readings above 50. March 1st too. China's National People's Congress. Any green stimulus announcements could spike solar-related buying. Globally, monitor LBMA silver auction volumes. A surge in premiums over $1/Oz confirms off-COMEX tightness. Geopolitical wildcards. Escalation in Middle East tensions might divert focus to gold, pressuring silver's ratio back toward 85:1, or safe haven flows could lift both. Scenario pathways unfold like this. Bullish continuation. Primary view confirmation. Registered stocks keep falling. Deliveries ramp and price breaks $82 on volume over 200,000 contracts daily. This could propel silver to $90 plus short term, next one free months, with structural outlook targeting $120 by end 2026 if deficits widen. Neutral some temporary pause. Stocks stabilize around 105 million, backwardation narrows, and price consolidates $75.85. Watch for this. If industrial data softens, leading to range-bound action structurally until Q3 mine output reports. Bearish reversal, sudden registration influx, e.g. 10 plus million ounces added, shorts rebuild to 90,000 plus contracts, and price slips under $70 on weak demand signals like falling ETF inflows, SLV below 500 million ounces. This might cap silver at $60.70 structurally if recession hits. Short-term next 2-4 weeks. Leans volatile with options expiration March 25th, potentially forcing gamma squeezes if implied volume spikes above 40%. Structurally, the multi-year deficit underpins upside unless major supply breakthroughs occur, like new Mexican mines ramping 10% faster. What confirms continuation? Consistent outflows, Asian premiums holding $10 plus, and mining strikes rumors in Peru. Signals reversal? Re-registration waves, demand downgrades from Silver Institute interim updates, or Fed rate cuts boosting dollar strength to suppress commodities. This roadmap equips you to track developments objectively. Set alerts on TradingView for these levels. Follow CME feeds and avoid FOMO. Now as we wrap this up, let's distill it all into a controlled conclusion. Flowing straight from that roadmap, with all the facts, mechanics, counters, and triggers laid out. What stands out as crystal clear right now is the undeniable strain on COMEX silver inventories. Registered stocks at historic lows amid surging deliveries and a persistent global deficit. This isn't fabricated drama. Verified data from CME and CFTC paints a picture of physical demand outpacing the futures market's comfort zone, with industrial needs from renewables and tech driving the bus. Yet, much remains uncertain. Will vault owners re-register metal en masse, or will the squeeze intensify? Could economic slowdowns temper demand, or geopolitical shifts amplify it? We don't have a crystal ball, but the evidence tilts towards structural tightness rather than fleeting hype, though counter-signals like stable eligible stocks remind us markets can pivot quickly. The single most important takeaway: observation trumps reaction every time. Don't chase the price spike or dump holdings on dips. Use the indicators we've covered to inform your moves, whether hedging with options, accumulating physical at premiums under $5/OS, or simply watching from the sidelines. Silver's volatility rewards patience and data-driven decisions, not emotional trades. If this breakdown helped you see through the noise, hit that like button, subscribe for more market deep dives, and drop a comment. What's your take on silver right now? Bullish squeeze or overblown fear? Share your thoughts below, and let's discuss. Thanks for watching, stay informed, stay smart, and I'll catch you in the next one. Peace out.